In this class we're going to talk about financial accounting. In a separate video we dealt with management accounting. So the accountancy profession may be seen in two parts. Management, which looks at the internal costs and production and so on within the firm. It looks inside the business. Financial looks at the financial affairs of the business, and in particular it presents information perhaps to outside the agencies, to stakeholders, the tax people, the stakeholders in terms of shareholders and so on. Anyone who's interested and who has a right to know. It depends on the form of the business, whether it's a public company or a private company. However, it is more outward looking and it looks at the financial position of the business. That's the point. Management looks internal. Now let's start by looking at a definition of accountancy. And this definition is fairly well used. It says accounting is a process using set procedures to collect, record and present financial data for a particular organization. Seems straightforward enough. The purpose of accounting is to describe and analyze the financial position and performance of an organization. Describe and analyze the financial position of an organization. And this means it facilitates decision making, because management will have better information, more accurate information upon which to make their decisions. Now let's go back to the top definition for a moment, and let's look at the key words there. It says accounting is a process using set procedures to collect, record and present financial data for a particular organization. So there are three sets of important terms there. And on the bottom it says the purpose of accounting is describing and analyzing the financial position and performance of an organization. So we have four parts. Now the key words to accounting, well, first of all, the process. Accounting function is a continuous process. It doesn't just happen sometimes throughout the year. Generally speaking, it is a continuous process. Records are being kept all the time. Day to day records are being kept of financial information that involves invoices, sales or costs and bank transactions and so on. So it's a continuous process of recording this information. It has set procedures. Accountancy uses rules and conventions. It has to do that so we can compare one company with the next, and we can compare companies over time. And these rules and conventions are enforced by the accountancy professional bodies. Accountants belong to professional bodies, professional associations, and they are members of those associations, and by virtue of that membership they are professional accountants. That means that they must abide by the rules, and the accountancy bodies ensure consistency over time and between businesses. So there are set procedures. They collect, record and present financial data. This must be done in an honest and open way and meet set standards. The data is normally collected using double entry bookkeeping. Every debit has a credit. So every transaction is recorded twice. It's recorded as a debit in one account and a credit in a different account. But the data must be honest. There must be an audit trail so that it can be traced back. If the company says it bought an asset for so much, it must have the asset. It must exist. So it avoids fraudulent behavior. And on the last part of not the definition, but the points on the earlier slide. It said describing and analysing. Well, published accounts are assumed to be honest and accurate. If they're not honest and accurate, then all sorts of issues arise. Tax obligations may not be accurate. There may be an intent to defraud tax payments. Investors in the business won't have accurate information upon which to make decisions, so they may be fraudulently treated as well. So describing the business honestly and accurately, that is important, and analysing it in a way that is consistent with the analysis conducted in other businesses, and one which exposes all assumptions that are made. Now, the functions of accountancy. Well, it presents a true and fair view of the financial position of the organisation. That's the term that's used, a true and fair view. The recorded data may be analysed and used to measure the efficiency and effectiveness of the business. So that's, in a nutshell, the functions of accountancy: to present a true and fair view of the business, and to analyse the recorded data, and to use the analysis as a means of making effective decision making. Now, financial accounting, which is the title of this class we finally got here, this branch of accountancy is concerned with presenting a true and fair view of the firm's trading position to external interested parties. The external parties could be the shareholders, as I said earlier. These are external in the sense that they are typically not involved in the day-to-day running of the business. The government, taxation and duties that have to be paid to the government, and others who may be interested in the firm's performance, for example, financial analysts. So the information must be true and fair, and it must be presented in a consistent manner. This type of accountancy is sometimes known as stewardship accountancy, because it's looking after the financial affairs of the business. It's stewardship. It's organising the business financially and making sure that the procedures are done correctly. It is the medium through which the managers of the firm account to the owners, the shareholders. So the managers are gauged by the manner in which they conduct the business, and that is shown through the accounts. So the shareholders can measure the effectiveness of the management through the accounts. Now, interested parties in the performance of the business. Well, the employees and their trade unions. Well, if you work for a business, you would obviously be interested in its performance. If the business is not doing well, your job may be insecure. Lenders, banks and other creditors are obviously interested in the business. Customers may be concerned about the security of supplies. If it's an item that customers find difficult to find, and perhaps it's the only one selling it, and the company is about to go out of business, customers would be concerned. So they are interested in the performance of the business. Suppliers of raw materials and semi-processed goods and so on, they may be interested because they may have given items on credit to the business. The government is obviously interested because of taxation and employment within the area. And the regulatory agencies, to ensure that the business is correctly run and not fraudulent. So it's important that the accountants present a true and fair view of the business. Now there's some more of these, so we can continue. Potential investors are also interested in the business. If investors are unsure that the data is accurate, the data upon which they're going to make a decision, clearly they will not make that decision, they will not invest. So they must have confidence that the information is accurate. Rival companies may also be interested just to gauge or work out their performance against the business. And the general public, if it's supplying some essential consumer good, the general public may be interested. For example, ethical pharmaceuticals, if it's supplying some drug that is necessary in the market and prescribed by doctors and so on. And if the company is about to go out of business, then that supply would dry up and the general public would be affected. Let's try to summarize this. The financial accountants are interested in the financial side of the business, as the name suggests. We would recognize the outcomes of their efforts mostly through the trading account, the profit and loss account, the balance sheet, the cash flow statement. That's where we see the final output of their work. But in fact, to get there, all the raw material, all the raw data, I should say, has to be analyzed, collated, organized. So everything from a single invoice on a particular day would have to be categorized, recorded twice, debit and credit, and finally integrated into the final set of accounts. The data that is presented refers to a specific date, and as such all accountancy data of this nature is historic. It's all fixed in time. So the accounts are of a particular date. The accounts as of the 31st of December or whatever. So although the process is continuous, at some point the data is collected and presented as a trading or profit and loss account or a balance sheet, whatever, or all three. Generally speaking, this happens together, but it's at a particular date. That's the point. They are intended, I'll just skip forward here too much, they are intended to present a true and accurate picture of the business to the outside world. And the accountants, through their professional bodies, are checked to ensure that they are competent and that they are honest and decent people, that they will do this accurately, no matter what. So they have standard procedures and conventions to ensure consistency between all the companies across time. So we know that all of the accounts for all the companies are compiled in the same way. They are derived in the same manner. And that gives consistency. So that's our overview of financial accountancy and of accountancy in general, and what it does and how important it is. There is a separate video on management accountancy, as I said earlier. In the meantime, this concludes this video, so thank you for watching.